Most hotels are full more often than people assume, and many still struggle to make consistent profit. That feels wrong. Rooms are rented every night. Prices change constantly. Demand looks steady. Yet behind the front desk, the economics are far more fragile than they appear. The core tension is simple. Hotels sell a perishable product that disappears every night it goes unsold, while carrying costs that never disappear. Filling rooms matters, but filling them cheaply can be just as damaging as leaving them empty. The industry constantly trades price for occupancy, and that trade rarely resolves cleanly. Hotels sit at the center of travel, commerce, and tourism. They serve business travelers, families, conferences, and vacationers. Cities depend on them to attract visitors and events. Because of that visibility, hotels are often assumed to be reliable cash generators. Rooms are standardized. Demand feels predictable. Brands are familiar. The business looks built for scale. In practice, hotels resemble real estate operations more than service businesses. Most costs are fixed or slow to adjust. Buildings are expensive to construct and maintain. Debt service continues, whether rooms are full or empty. Staffing, utilities, cleaning, insurance, property taxes, and maintenance persist even when demand weakens. Revenue moves daily. Costs do not. The product hotels sell is unusually fragile. A room cannot be stored or sold later. If it goes empty on a Tuesday night, that revenue is gone forever. To avoid that loss, hotels discount aggressively. Prices are adjusted constantly through revenue management systems, which attempt to balance supply and demand in real time. This creates volume, but often erodes margin. Higher occupancy does not automatically produce higher profit. A full hotel filled with discounted rooms can generate more wear, higher labor costs, and rising variable expenses without improving cash flow. In some cases, it makes the economics worse. Distribution adds another layer of pressure. Many bookings flow through online travel agencies, which charge commissions that can reach 15 to 30%. These platforms deliver demand, but they also take a significant share of revenue. Direct bookings are more profitable, but harder to secure, especially for independent hotels without strong brand recognition. Branding introduces further complexity. Large hotel brands, such as Marriott, Hilton, and Hyatt, often do not own the properties that carry their names. Instead, they operate asset-light models. Hotels are owned by third-party investors, while brands franchise or manage them. The brand earns fees tied to revenue and performance. The owner bears the financial risk. This separation shifts incentives. Brand companies benefit from expanding room count and system-wide revenue. Individual owners care about net operating income after expenses and debt. A hotel can be busy, well-branded, and highly visible, while the owner struggles to generate acceptable returns. This dynamic is especially clear in the Marriott system. Marriott is one of the largest hotel companies in the world with thousands of properties across dozens of brands. Yet the vast majority of those hotels are not owned by Marriott itself. They are owned by real estate investors who pay Marriott to manage or franchise the property. Under a typical management or franchise agreement, Marriott earns base fees tied to gross revenue, incentive fees linked to performance, and additional charges for branding, reservations, loyalty programs, and marketing. These fees are collected regardless of how thin the property's margins may be. For the hotel owner, this structure can be challenging. A property can achieve strong occupancy, solid pricing, and consistent brand recognition, yet still struggle to generate sufficient cash flow after fees, operating costs, and debt service. Marriott's incentives align with growth and system-wide performance, while the owner's returns depend on a narrow margin at the property level. This does not mean the model is broken. It explains why outcomes differ so widely between the brand and the asset owner. Marriott can be highly profitable, while many individual Marriott-branded hotels operate with limited financial cushion. The pandemic exposed how thin these margins were. When travel stopped, revenue collapsed almost overnight. Costs could not fall quickly enough to match it. Many hotels closed temporarily. Others negotiated with lenders or injected new capital. Even well-located properties with strong brands faced severe financial pressure. When travel returned, the recovery was uneven. Leisure demand rebounded faster than business travel. Weekends improved. Midweek occupancy lagged. Hotels raised prices in some markets, but labor shortages and higher wages offset much of that gain. Inflation pushed operating costs higher. Insurance and maintenance became more expensive. Profitability improved in pockets, but volatility remained. A key realization followed. Higher average daily rates did not guarantee healthier economics. Average daily rate measures the average price paid per occupied room. It is a common performance metric, but an incomplete one. Higher rates can suppress occupancy. Lower rates can increase wear and operating costs. The optimal balance is narrow and constantly shifting. Seasonality makes that balance harder to maintain. Hotels and tourist destinations experience sharp peaks and troughs. Rooms sell out during certain months and sit empty during others. Fixed costs stretch across the entire year. Profits earned in peak periods often subsidize losses in slower seasons. Urban hotels face different pressures. Business travel is sensitive to economic cycles. Conferences can be canceled or relocated. New supply enters markets quickly when demand appears strong, putting downward pressure on prices. Once built, that supply does not disappear when conditions change. These dynamics explain why hotel ownership is often a long-term, yield-focused investment rather than a high-margin business. Returns depend on appreciation, leverage, and tax treatment as much as operating profit. Cash flow alone is often insufficient without favorable financing or sustained market growth. The broader lesson mirrors what appears in many capital-intensive industries. Visibility and volume create the impression of profitability, but they can hide structural constraints. When revenue fluctuates and costs are fixed, small shifts in demand produce outsized financial effects. Hotels are everywhere. They are essential to travel and commerce. They look like obvious winners, yet the business behind them is a constant exercise in trade-offs that rarely disappear. High occupancy does not eliminate risk. Strong brands do not guarantee profit. Full rooms do not always mean healthy economics. In the end, the hotel industry shows how difficult it is to build durable profitability around a product that expires every night, even when demand appears strong.